I'll start with my topic, which is an overview of Exxon Mobil's quarterly results. So, just a brief synopsis. Exxon Mobil is one of the large energy players in the United States. They do both upstream activities and downstream activities, meaning that the company covers the entire energy value chain, meaning that the company covers the mining, refining, and retail activities as it relates to energy production. So we talk about petroleum products, so fuel in many forms, both in terms of new fuel products that go into hybrid vehicles and also traditional petroleum products. So how did the company do for the 6 months period ended June 2023? So let's start with revenue. The revenue is down 17.8%, but operating costs also fell 18.3%, and net profit after tax is down 17.2%. So let's speak about some of the drivers. The West Texas Intermediate oil price fell from $114.68 per barrel to $70.31 per barrel over the period. So we'd have noticed a 38.8% fall year over year in energy prices. And with such a large downward move in energy prices, it would have affected the revenue that the company earns. Now, for perspective, in terms of the year over year move for the next quarter, we anticipate a smaller decline. So we saw a decline of 38.8% year over year for June, but the move for September is expected to be 11.4%. So we don't expect revenue to be down as much. But the grander play for a company like Exxon is more long term. Why is that? That's because energy supply is actually declining on a macro level. What does that mean? It means that the demand for energy is sustained, but energy supply is not sustained at the same pace. So it means in the next 3, 5, 7, 10 years, energy supply is likely to become more and more constrained, which is why there's a big rush for Guyanese reserves. So for those who are inclined in terms of risk appetite, Exxon Mobil is one of the largest players. They've been doing this for a long time, for decades, and they're well capitalized. It's a company that's investment grade. They have a strong balance sheet, and sometimes as investors, we have to look at companies while they're having a difficult period, especially companies that have very strong fundamentals. So it's something I call the ugly duckling principle. So you have to make the investment while it is an ugly duckling, so that when it's no longer an ugly duckling and everyone else realizes, you would have absorbed all of that value, because we want to buy cheap and sell high. In terms of the price, the company is trading at $156.65, and that's down 17.4% compared to the 52-week high. It's also down 4% from the 200-day moving average, and the PE is 10.19 times. So the market average in the US is closer to about 16 times. So it's much cheaper than most of the US market right now. The return on equity is 19.26%, which means that even though we would have seen a fall off in revenues and profitability, the company is still performing handsomely, because typically we want a return on equity of 10 to 12%, and now it's at 19. So this is a company that has a very strong long-term outlook. Even though the period is seeing a decline in terms of revenue and profitability, it doesn't sum up the actual position of the company. So it's an opportunity for investors who want to take the risk and want to look for a longer time horizon, that's 3, 5, 7, 10 years, to get some value. The dividend yield is also above 2.5%, which is attractive. So we're not just talking about the potential price move because of where the company is and where the company is likely to be in the future, but also we can also look at it for income. So it's income and the potential price move. Just to round off our discussion around energy, Chevron, which is a competitor to Exxon Mobil, is acquiring Hess, another energy player, basically the number 3 player in the market, for US $53 billion. So what that means is that if there are less energy players in the market and there's falling supply, it means that less players will be controlling or reducing supply in the market, which means that the market overall, in terms of the market structure, is moving closer and closer to a monopoly. So if there are less players controlling the same amount of oil, each player that is still in the market will have more pricing power, which means higher revenues and higher average energy prices as time continues. If this consolidation continues, which is what we expect. So that's better profit margin for the energy players that are still in the market going forward. And as we know, Chevron is one of the stronger players and we expect them to stay around, and also Exxon Mobil. So that is my summary. A potential catalyst is the Hamas-Israeli conflict. If it escalates, energy prices could also break out into a new trading range, move from the 80s range to the 90s, especially as we go into 2024. And we have to consider the fact that the US is loyal to Israel. It could spur into something bigger, which is an opportunity for investors to consider energy as a sector. And ExxonMobil is a good avenue to enter energy as a sector. So, Keisha, over to you.
Wait 1 second, everybody. Good night, everyone. Producer Sachel from behind the scenes here. I have a question for Julian. So Exxon is playing a really big role in developing Guyana's oil segment. How do you think that everything that's happening in Guyana will affect Exxon in the long term?
Well, let's backtrack a bit. So, in terms of energy supply, the US is one of the leading producers. I believe US is in the top three. And what we need to pay keen attention to is the fact that the US has the strategic petroleum reserves. And over the last 3 years, the strategic petroleum reserves have fallen off significantly. So, to color the discussion, the fall off in the strategic petroleum reserves means that the US cannot continue to supply itself and the rest of the world with only US supply in terms of energy and oil reserves, which would spur the largest energy producers in the world, which are US oil companies, to look in new places, which is how Guyana comes into the discussion. Guyana is turning out to be within the top five in terms of potential energy reserves, natural energy reserves, in terms of volume. And if it has that much untapped potential, then it would spur the largest energy producers, which are US companies, to go into that territory to get this oil cheap in a South American territory and be able to supply it to the world with its technology and expertise to get a good margin. So it's a story of supply, it's a story of scarcity in the US, it's a story of catalysts such as outbreaks and conflicts. And also, what we need to remember about energy is that as oil reserves become more depleted or exhausted, each additional barrel of oil is more expensive to produce because the further the oil gets away from the surface is the more costly it is to produce each barrel of oil. So to keep oil affordable or to keep the oil supply sustainable, companies have to keep finding oil reserves that are fresh, because the more oil reserves that get exhausted, the more expensive it gets to produce each additional barrel of oil, which not only means higher energy prices but reduced profit margins because they can only charge so much at a time. So we need fresh oil, oil that is cheap to harvest, to get the supply right and to also drive the volumes. So that is the importance of Guyana.